traders, welcome to Quantsapp. My name is Varun, and a lot of traders have been asking me to do a video about a triggers tool and mainly how you can scalp on an intraday basis. So everyone keeps asking me that a lot of times indices go sideways, so we need to look at some stocks for our intraday trades. So how can you use a tool or any analytic to its fullest to scalp some points on maybe some stocks? So this is a very simple topic actually. So I'll explain the concept, I'll make you guys conceptually strong, and then we will see what the actionable thing is. So it will be why to do it, how to do it. Okay, so what exactly is the trade? I will explain that as well, how to trade all of these things so that you can do it independently on your own. Okay, so for people who do not know, my name is Varun. I'm sure that you guys have seen some previous videos, but in case if you haven't, I am the trainer here at Quantsapp. I hope you guys enjoy this video. Just sit back and relax. And I hope that you will learn something new from this video. All right. The support has been immense for the people who have been watching these videos continuously. I always read your comments. I always, see the reactions to the videos. So I am quite happy as of now. And just keep those coming because that is the only motivation that I have. Okay. So let us start. First things first, I would just like to show the concept. So I'll just open Quantsapp. So this is the screen of Quantsapp for people who do not know. I am on a desktop. So I have opened the web app, which is web.quantsapp.com. You can access it through any browser. But if you are on Android or iOS, we have a mobile application available on the App Store. So any mobile platform can install our application from the App Store. Okay. So let us start. Now, first things first, what I normally use to identify trades is a simple option-based analytic. It is open interest. So you can just search it, right? So I'll just go to the search option, and under the search option, you can just search for open interest. So open interest is one of the most dominant analytics that a lot of people use. I'm sure that you also use it. So I will explain how to use open interest and how you can analyze certain things in a very effective manner. Okay, so today it was Nifty's expiry. So what I'll do, I'll just select the expiry for the next date. So next up, we have the monthly expiry, which is 27 June. As of filming this video, 27 June is the monthly expiry. Okay. All right. So this is the open interest data that you can look at inside Quantsapp. I'll just zoom in a bit for you guys, but you all can see it much clearly. Okay. These are the bars. Okay. So there are some green bars, there are some red bars you can see. So this is open interest data. On the left hand side, the scale shows various strikes. Okay. And at the bottom, the x-axis will show you the absolute quantity of open interest. All right. So how do you analyze this? What exactly are the bars? Why have we used it in a vertical manner and stuff? So normally, if you look at open interest data comes in a vertical chart. Okay. What we have done, we have arranged it in a horizontal manner so that you can actually see the resistances and supports. So it is visually much more appealing and you have an overall better experience when trading with the help of this data. So this is something that a lot of traders have loved inside Quantsapp, so you can use it as well. But how I analyze it, I will explain. Okay. So green bars are call open interest. Wherever you see a green bar, that is call open interest. Wherever you see a red bar, that is put open interest. Okay. If there is dark green or a solid green color, that indicates addition. So for example, on this particular strike, if I annotate, let me just draw for you. Okay, so on this particular strike, I can see this much open interest addition has occurred, or this much call addition has occurred. Okay, on the flip side, there is a solid red color. So here you can see this is depicted, this particular area is depicted as addition. So you can actually see the quantum of open interest that was added, and you can quantify those new positions that are being created. So I will explain exactly how you can trade with the help of this as well. But before that, let me just touch up a little bit for the beginners what exactly is open interest. So open interest, for people who do not know, it is nothing but number of open contracts. Okay. So futures has open interest, options have open interest. Both of these are contract based instruments. Okay. Now, whenever we say, let's say market is at 20,000, just an example, I'll just type it down for you at the blank space. Okay, ignore everything else. Let's say market is at 20,000. So 20,000 is the CMP, okay, current market price. Let's say if open interest has been added by 100. So that means 100 new contracts are added. So this is futures open interest and above its futures price. Okay. This would mean that there is 100 buyers plus 100 sellers. As simple as that. Right. So 100 new contracts, 100 buying quantity and 100 selling quantity. Right. So it is almost impossible to understand where the market will go just based on open interest because they're buying as well as selling. So based on this, market should go sideways. So that is how normally open interest is looked at from futures perspective. In options, it is slightly different. So why is it different? Because inside options, we always choose or assume the perspective of option writers. So inside futures, whenever we talk about open interest, we talk about both buyers as well as sellers. Why? Because buyers and sellers both have undefined risk or both have equal risks and equal rewards. So it's a much more fair playing ground when it comes to futures trading. But options, there is slight complication, right? So the complication is that inside options, option buyers always have a limited risk and option writers always have undefined risk. So same thing if I type here, right? Let's say if I type, let's say instead of 20,000 being the current market price, I take 20,000 CE, so call option. Okay. Let's say 20,000 call option has experienced an open interest increase of 100 contracts. So here it's the same thing. There's 100 buyers and 100 sellers. But we will choose the perspective of option sellers or option writers. Why? Because option writers have the potential of losing a lot more. So option buyers can actually afford to make mistakes, but option writer, whenever he is entering a trade or whenever he is creating a fresh position, he can never go wrong, right? Or he cannot afford to go wrong. He can go wrong, but he cannot afford to go wrong. So whenever option writer places a trade or creates a new position, he always thinks about it maybe 100 or 200 times, right? So that is the general idea. Now this is how open interest is generally used. I'll just get rid of everything. Okay. This is how open interest is used. Now, what we are going to learn today is we are going to learn how to identify where option writers are losing money. Right? We are going to learn where option writers are losing money. How can we identify that? Right? Can we identify whether we can actually see who is aggressive and what is going on? We can actually see. So it's quite easy. Inside open interest, there are multiple bars. You can see there are multiple red bars, there are multiple green bars, but major concentration comes right around the future price. So the future price as of now is 23,597, right? So around that you can see there are huge green bars and huge red bars. What I generally look at, I always look at the biggest green bar and the biggest red bar. So in this case, as of now, if we look, then the biggest green bar is right here. So if I just draw it, let me just zoom in for you. Okay, so the biggest green bar, annotation, biggest green bar is this one, and the biggest red bar is this one. Right? So that means the most call writers, most call writing positions are being created at this particular strike. Right? So call writers are pretty much confident that price will not move beyond this particular strike. So they are expecting that the market will expire below 24,000. So on the monthly expiry, everyone is expecting the market will expire below 24,000. Right? All the call writers are expecting. And what are the put writers expecting? The put writers are expecting that the market will expire above 23,000. So major writing concentration on the put side is 23,000 and on the call side is 24,000. So this 1,000-point range is where the market might expire. Okay. Now, just think of a hypothetical scenario. we know that writers are betting on these particular prices, that the market will expire between these prices. What if market moves above this price? Okay. What if market moves above 24,000? So before expiry, we still have a few days to expiry. Let's say market moves above 24,000. What will happen after that? So at that point, the call writers who have actually sold their options at 24,000, or the call writers who have created position at 24,000 strike, they will start to panic. They will start to panic. They will shift their positions to a higher strike. So this is where we know that call writers are about to lose money, and then they might shift the positions. So whenever you see a call writer shifting their position or whatever the case, they will always shift the position before suffering a loss. Now you can think of it this way. If you are a call writer, will you actually square off after price moves up or before price moves up? So if I am a call writer, I will try to preempt the market. I will try to predict the market. And if market is in a bullish rally, I will square off my position much earlier. I will not let the price cross my strike price, then I square off it. I won't suffer that loss. So majority of the times you will see unwinding before future price crosses this particular strike's price. Right? So unwinding can be actually seen by this. So if you see a green hollow section, that means there is unwinding. So you can see here, it's written here right here. So there is negative 7,15,950 open interest on this particular strike. So this again can be seen. So under red, if I can see an example. Okay, so put strikes don't have unwinding, but you get the point. If you see a hollow section in the put strikes or in the red bars, or a hollow section in the green bars, that means there is unwinding happening. So there is a very good chance that there will be call unwinding much before the price reaching 24,000. Right? So call writers can preempt whether there is a breakout or there is a breakdown. So this is known as open interest breakout. And if the price crosses below the heaviest put, that is open interest breakdown. So this is a very simple concept of breakouts and breakdowns based on open interest. So you can think of it this way, that the heaviest call or the highest call, heaviest call or highest call is the same thing. It's the strike with the most call open interest. The strike with the most call open interest, which is this strike. And heaviest put is the strike with the most put open interest. So this is the strike right here, right? So these acts as resistance and support. So the heaviest call is the resistance and heaviest put is the support. So market majority of the times will close in between these ranges, or it will expire in between these ranges, because writers obviously do a lot more research. But a lot of times it also happens that their view is wrong and market provides a good rally. A good example would be Chambal fertilizer. Chambal fertilizer today, it is up by around 18%. Chambal fertilizer is up by around 18%. So you can see that it is in the ban list as of now. You can see that the name of the symbol is red. So that means it is in the ban list. So majority of the strikes have unwindings. Right? So you can clearly see the heaviest call was somewhere around here at 470. Current price is, I guess, around 500. I'm not sure what exactly is the current price of Chambal fertilizer, but Chambal fertilizer, I'm pretty sure is trading a lot higher. If I open option chain, I'll open option chain. Okay, 551 is the current price. So today it is up by a lot. Actually, you can see that it is in the ban list. Even these options are not even traded, but the heaviest call was at 470 today. And the 470 level was broken, and there is a very good rally inside Chambal fertilizer. So that is how you can analyze these things. So again, to summarize or to recap real quick in simple terms, just look at open interest data. Again, I will just type Nifty because Nifty is the simplest to explain. Okay, Nifty is added here. Okay, just select the monthly expiry. So current weekly expiry, you can look at weekly expiry, but weekly expiry is actually the expiry was today. So does not make sense to look at that data. All right. So we wait for the price to move close to the heaviest call or the heaviest put. So the biggest green bar or the biggest red bar. You can call it resistance and support. So we wait for the future price to move near this or near this. Then as soon as we see unwindings, we can go and actually enter a trade. Why? Because the writers are about to lose money, the call writers or the put writers are about to lose money. That means the market will move in that particular direction. Right? If call unwinding is there, that means the market is about to break the resistance. So the market will do a good rally on the upper side. If there is put unwinding and market is close to the support, that means it will break the support and there could be a good bearish rally. So this can be used on an intraday basis, but there is small problem. Okay, one small problem arises that how will I know? Right, out of the entire F&O basket, there is around 187 scripts, if I'm not wrong. So out of those, we have 5 indices and 182 F&O stocks. So out of all of these stocks, how will I know which stocks have a breakout or which stocks are about to experience a breakdown? How will I know? So we need to preempt this because we will not enter a trade once the breakout has already happened, right? So Chambal fertilizer, for example, I will not enter a trade right now because the breakout has already happened and Chambal fertilizer has moved up really good, right? So how do we analyze these things? So these things can be analyzed with the help of a simple tool named triggers. So I'll open a new tab for you guys and I'll just search for triggers. We'll let it load, search for triggers. Trigger, as the name suggests, it will show you where you should enter a trade, or it will show you where your entry is triggered when you are buying options. Because it's a simple thing. If writers are losing money, then option buyers or in general directional traders have a chance to make money. So that is the general idea here. Okay. All right. So here you can see on the left hand side there is data for highest calls, and on the right hand side there is data for highest puts. So let's just take an example. Let's type Nifty. Okay, Nifty, you can see highest call strike is at 24,000 and highest put strike is at 23,000. Just like we analyze with the help of open interest data. All right. The thing that we need to look at is call difference and put difference. So what exactly is call difference and put difference? It is a percentage number that shows you how far off your future price is from the heaviest call strike. For example, current price of Nifty is at 23,597. I'm sorry, I fumbled a bit, but current price of Nifty is 23,597. The heaviest call strike is at 24,000. So Nifty still needs to go up around 400 points for it to get close to this strike. So how far is it? It's 1.7% away from its breakout. So Nifty still needs to climb up by around 1.7% for it to actually experience a breakout. So it is 1.7% away from a breakout. Put difference, similar thing. Put difference shows that it is 2.53% away from a breakdown. So it needs to fall 2.53% for the writers to actually start to lose money. Alright. So call difference and put difference, if there is an impending breakout or if the breakout is pending, there is no breakout or breakdown, then call difference and put difference will both be positive. Right? It can be negative as well, but I will show you some examples of negative. Okay, let me just take an example. Let us just look at Infosys. Infi. Okay, Infosys, the heaviest call strike was 1,500. Okay, current price of Infosys is 1,550. Has the breakout occurred? Yes, the breakout has occurred because future price has moved beyond the heaviest call strike or the resistance. So how much of a move has it produced? So post breakout, after breakout, it has moved up by around 1%. So it shows negative 1%. Why? Because it is 1% above the heaviest call. So it has actually experienced a breakout, right? Similar thing can be there for put difference as well. If I just show you put difference, let's take one example. Bharti Airtel. Bharti Airtel heaviest put or the support is at 1,400. Its current price is 1,384. So it has experienced a breakdown. How much of a move has it produced after the breakdown? So it is 1.15%. So put difference is negative this time because the breakdown has actually occurred. So that is the general idea. All right. So it has fallen down by around 1.5 or 1.15% after the breakdown. So we don't enter a trade on negative call difference or put difference. We enter a trade when it is positive. So 0 to positive 1% is the general sweet spot that I normally recommend. So what I like to do, if I'm going for a bullish trade, I just click on call difference. Okay. I will check all the stocks that have a call difference between 0 to 1%. Okay. So the last negative one is MGL. Okay. So from Gracie, I will check all the stocks below. Now, it is very important to only look at the left hand side or the highest call section and ignore the highest put section. So if you are going for a bullish trade, only look at the highest call section. If you are going for a bearish trade, only look at the highest put section. Don't look at both of those simultaneously. You will not achieve anything. Okay. All right. So that is the general thing because I get a lot of queries based on that. So I just wanted to clear it. Okay. Out of all of these stocks, I will enter a trade in Dr. Reddy. Now, why exactly Dr. Reddy? Because Dr. Reddy's future price, you can see, it's 5,975. Its heaviest call strike is at 6,000. So that means it is very near a breakout. So it only needs to climb up by around 0.4% for it to actually experience a breakout. Second thing I would like to point out is change in open interest. So change in open interest for this particular call option. So the call option of 6,000 rupees in Dr. Reddy has experienced an unwinding, open interest unwinding of around 13%. So let's just explain this. I'll take India Hotel and Dr. Reddy, for example. Okay. Let's take India Hotel first. In the hotel, India Hotel. Okay. Now you can see that the biggest green bar or the resistance is at 640. The future price is at 639. So that means this is about to experience a breakout. So if the breakout was sustainable, then you would see unwinding on the heaviest call. But instead you see addition, massive addition at the strike of 640. This means that call sellers are pretty much confident that this breakout will not sustain and India Hotel price will fall. But if you look at Dr. Reddy, so inside Dr. Reddy, you can see that the heaviest call is about to break, and you can see multiple call strikes have observed unwinding. So multiple call strikes are experiencing unwinding. So there's a very good chance that Dr. Reddy would move up. Right? So writer sentiment is also very important. So you can analyze these things as well. So call change in open interest is the one thing that will help you about participation. Right? Same thing if I'm going for the put side, I'll just click on put difference. And from 0 to positive, I'll just try all of these. So Abbott is the last negative one with put difference. Okay, Tata Motors and Bill. So from Tata Motors, I'll check out all the stocks. So on the put side, I can see a lot more stocks are about to fall. So Container Corp, I can see Container Corp is about to give a breakdown. So 1,100 is the heaviest put or the support. 1,101 is the current strike, current market price. Okay. We can already see unwinding is about to, it's already happened, right? Unwinding is already started to happen. So Container Corp would further fall down, right? Lalapath Lab, again, same thing. Canara Finance Home, same thing. DB's Lab, same thing, right? So wherever you see unwinding starting to happen, you can actually enter that trade. At least based on data, there is a good chance that you can enter that trade. So that is how you can use this thing. Intraday trades are the way to go. So you can trail your stop loss. You can trail your stop loss to exit as well, right? So you can do that, or you can take targets based on open interest. So that is also fine. I generally trail stop loss, so you can trail your stop loss as well to go and take an exit. All right. So that is the simplest thing that I can give you. Like for example, let's just check out Infosys. Right. Let's say if I had entered a trade on Infosys, just an example. Okay. So the first thing on the call side, I believe we have Chappal Fertilizer. Let's take maybe Okay, Cipla has also moved up. Infosys. Let's take Infosys for example. If I was trading Infosys, okay, I'll just open chart of Infosys. Okay, Infosys resistance was at 1,500. So I'll just add 1 minute chart of Infi. Okay, 1 minute chart of Infosys. This is the 1 minute chart of Infosys. And what I'll do, I'll just add resistance. Okay, so 1,100. Okay, 1,500, sorry. I just apply this. All right, so Infosys, if I look closely, okay, Infosys actually has a breakout around here, and it was because of a gap up. So I don't think Infosys there was an intraday trade. Okay, there was no intraday trade on Infosys, so forget Infosys. Let's look at maybe Cipla. Has Cipla given a breakout? Cipla is not in the ban list. I was just checking that. Let's see. When did Cipla cross its support? Cipla, okay, Cipla has been falling down, so forget Cipla as well. Should we maybe look at IndusInd Bank? Let's look at IndusInd Bank. IndusInd Bank actually, again, IndusInd Bank today, what happened to IndusInd Bank? It has fallen down and it has moved up. Okay, again, let's look at something else. Maybe on the put side, I just want to give you an example of trailing stop loss. So let's see, maybe ITC. ITC, has ITC fallen? Let's check ITC. Okay, so ITC has gone ulta actually. Forget ITC then. Maybe Bharti Airtel. What about Bharti Airtel? Okay, Bharti Airtel has a decent example. What about the support of Bharti Airtel? Bharti Airtel has a support of 1,400. Let's just add the level of 1,400. 1,400. All right. Okay. So we can see that Bharti Airtel had experienced a breakdown somewhere around here. So yesterday there was a breakdown, but I'm not sure if there was unwinding yesterday. But today I know that there was unwinding somewhere around here. So once Bharti Airtel crossed this move, right? Once Bharti Airtel crossed here, somewhere you would have entered around this price, around 1,400 price, because 1,400 is its support. Okay. After that, you can keep on trailing stop loss. So you could set a stop loss of day high. So this could be my stop loss somewhere around here if I just add a price range. So from here to here, I could keep my stop loss. Right. So 10-point stop loss. Against that, I can keep the same stop, same as target. So 10-point target, I can keep that, or I can trail my stop loss. So I'll just add a 5-minute chart instead of 1-minute chart. 5-minute charts are much easier to read. So I can see that there was a breakdown here itself, right? So keep a stop loss of somewhere around here, because you can see that there is a resistance here based on price action. And you can enter the trade somewhere around here. You will maybe square off based on a 1:1 reward to risk. I would say you will square off somewhere around here, right? You can keep that. Or if you want, if you are entering a trade on candle closing, then there is a 14-point target. 14-point stop loss, 14-point target. So somewhere around here you will square off, or somewhere around here you could square off. So always try to keep a 1:1 reward to risk based on price action, and then you can enter those trades. So that is it. That's quite easy if you want to analyze these things. I don't think it's that much difficult to trade stop loss or set targets and stop losses, but you can do it manually as well. A lot of times it does happen that the breakout has occurred 2 days prior, but still it is showing in triggers, like we saw on the bullish side. On the bullish side, we saw Infosys, then LTI and IndusInd Bank. The breakout happened way back, but after that the market has been consolidating, so the stock is still around here. But intraday move you could have easily captured. So that is how you can analyze these things. All right, then. That is it for me. I hope you guys enjoyed watching this video. I hope you guys learned something new. The support has been tremendous on these English videos. I have started to do some English videos, so as per your request. And again, then thank you so much for watching. My name is Varun again. I will see you guys very soon in the next video, and all the best on your trading journey. Thank you guys. Thank you so much.